How much should I risk when trading? Most traders blow accounts and profits because their position sizing is trash. They risk too much when emotional, too little when confident, and they have no real system designed to help control their downside. Today, I'm gonna show you a wagering strategy based on a powerful mathematical formula that has been used to beat casinos and manage billions on Wall Street, and how we adapted it into a simple blueprint for short-term trading inside the 20-minute trader. And the story behind it is incredible. Back in the 1950s, a scientist named John Kelly worked at Bell Labs, one of the smartest research centers in the world at the time, where engineers and mathematicians were solving problems about telephones, computers, where the transistor was invented, and how to send information clearly over noisy communication lines. Kelly was fascinated with how messages could travel accurately, even with interference, so he borrowed ideas from another legendary scientist named Claude Shannon, often called the father of information theory, the man who showed that information could be measured almost like weight or distance. While working through the math, Kelly stumbled onto something unexpected. Not just a formula for cleaner communication, but a formula for money. One that showed exactly what fraction of capital traders should consider risking when they had an advantage. Too small and growth was slow, too big and they risked blowing up. But just right, and the smart traders can improve growth while managing downside. This became known as the Kelly Criterion. A few years later, a mathematician named Edward Thorpe discovered Kelly's work. Thorpe was obsessed with blackjack and invented card counting to track which cards had already been played so you could tell when the deck was hot in your favor or cold against you. He realized knowing you had an edge wasn't enough. You also had to know how much to bet. Kelly's formula changed everything, telling him to bet small when the edge was small and bet bigger when the odds were in his favor. And using this system, he walked into casinos and actually beat the house so consistently that casinos changed the rules and banned players they suspected were using Kelly-style strategies. Then, Wall Street caught on, and by the 1980s and 1990s, hedge funds realized every trade was just a bet with probabilities, risk and reward, and firms like Renaissance Technologies began using modified Kelly systems to balance growth and volatility. What started as a math problem about phone lines became a weapon for gamblers, and then a risk management strategy for billion-dollar investors. And we adapted that same concept into a simple wagering blueprint for short-term pattern trading. Now, before we go into the steps, you must clearly understand what your stack size actually is, because this is where most traders get confused. If you're trading your own personal account, your stack size is the full value of that account. If you have $2,000 in your account, that's a $2,000 stack size. Then you decide what percentage of that you are truly comfortable risking per day. Meaning, if you lose it, you will not be emotionally upset. You will not revenge trade, you will not spiral, and that daily risk number becomes the foundation of your blueprint. If you're trading a prop firm account, the advertised account value is not your stack. They give you a $50,000 account, but your maximum loss limit is $48,000. Your real stack size is only $2,000. That $2,000 is what you must think in terms of, because that is the actual capital you're allowed to lose. Generally, we use 12.5% of the stack size for our equations. But if I personally had a much larger account, I would lower that to 5%, 3%, or even 2% to protect more capital. The most important rule is this: you must be completely okay with losing your daily loss limit without going on tilt. If that number is $100, then that is your number. If that number is $50, then that is your number. If it is too small for the mechanics of trading to function properly, then you must adjust, because trades cannot get infinitely small. Once you determine that daily loss maximum, everything else becomes structured math. Step one is a daily loss maximum, the amount a trader is willing to lose before stopping for the day. Using our example of a $2,000 stack and 12.5% risk, that equals $250. If the trader hits negative $250, they are done for the day. Step two is position sizing. Every trade risks 50% of whatever remains before hitting that daily loss limit. So the first trade would risk about $125 with equal take profit and stop loss. If it loses, the next trade becomes half of what remains. If it wins, the trader will transition into the ladder technique, which is easy, so don't run away. Now let's clearly walk through the ladder technique with real numbers. If the first trade wins and the account is up $125, instead of risking the full daily limit again, the the trader risks a portion of the profit. I use about 30% of daily profit. So if I'm up $125, I risk about $40. If I lose that 40, I'm still up $80 and I immediately lock out for the day. Green stays green. If I win that 40, now I'm up about $160, $165. I then risk roughly 30% of 160, which is about $55. If that wins, now I'm up over $200 in the green and I risk around 65 or 70. I keep doing this. Win, increase profit, risk a small portion of the profit, win again, increase profit. The moment there is one loss, I stop trading for the day. This creates effectively unlimited upside during winning streaks while sharply limiting downside. I've personally had many days with 5 or more consecutive wins on the ladder where the account is up $250, $300, $400, even $500 using this wagering strategy. And when a loss finally comes, I'm still walking away with strong profit locked in. That is the power of structured risk. And if a ladder loss does occur earlier, the base wagering strategy still allows recovery by only risking 50% of remaining daily loss room. Now, here's where it gets even simpler. Inside the 20-Minute Trader Club, we provide a proprietary wagering tool that does all of this math instantly and for the trader mathematically. They simply input their stack size, whether that is a personal account balance or a real prop for maximum loss limit, and then input the percentage they want to risk daily, and the tool instantly calculates the next risk amount based on remaining room or current profit, including ladder calculations. There's no guessing, there's no mental math, there's no emotional decision making. It breaks down the precise dollar amount to risk per trade in real time based purely on math. That wagering tool is available inside the 20-Minute Trader Club, which is one of the world's most popular go-to trading communities for non-traders and beginners who want structured guidance getting into trading. The club includes the wagering calculator, training, community support, and live guidance. And if you want to understand not just the wagering blueprint, but also our most back-tested and highly probable predictable pattern trading strategy, the gold pattern, we explain all of that inside our free web class where you can get your questions answered live from real live people. We're still offering it. You will find the link in the description. If this video helped you, please like and subscribe. It helps grow the channel and allows us to bring this kind of structured trading education to more people. This wagering strategy may look complex at first, but once you learn it, you will have what is, from everything I have seen, and in my opinion, mathematically higher probability way to determine exactly how much to risk on every trade and every day. That is how we teach our students to help protect capital, recover intelligently, and build consistency over the long term. See you in the next video.